We want to bring in Kelsey Berro, JPMorgan Asset Management Fixed Income Portfolio Manager. Kelsey, it's good to see you. So just first your reaction to this move higher that we've seen in yields. And now that we're at that 4 or 5 level, Maddie was just mentioning 4.7 could be that next level to watch. What do you think?
So it's been a large move today, but it's also been a rational move. So the Fed has been holding on to the idea that they could cut as soon as June and they could deliver 3 cuts this year. And that path to that outcome has narrowed a lot. And as a result, the market has priced out the number of rate cuts to less than 2. But I think that right now we're dealing with some extremes. So if you look back to Q4, that was an extreme. Inflation undershot what the trend was, and the market way overpriced the number of rate cuts. They were pricing as much as 7 or 8 rate cuts. Now we're testing the other extreme. These extremes tend to create opportunities for investors. So if you were looking for that entry point to lock in yields, you found another one today with this move higher, particularly in the front end.
Right, I was just going to say, where's the best entry point for investors? So you're thinking 2-year?
Yeah, the 2 and the 5 and the 10-year, that intermediate part of the market. And I think the other thing that we're really focused on right now is not so much the path of the Fed, but it's the strength of the corporate fundamentals and the balance sheets of companies. And so the primary place that we're focusing our risk budget in fixed income portfolios is actually on the credit side and a little bit less on focusing on the day-to-day of what the Fed is going to be doing. Will they cut in June? Will they cut in September? Will they cut in December? The key, though, is that even though we're pricing out rate cuts, we're not talking about restarting rate hikes. And that's really important for investors right now. Yeah, we're talking about the Fed delaying, but we're not talking about a regime shift where we're talking about rate hikes again.
So the Fed does move sideways from here, meaning that they don't cut, but they're also not raising. So we're in this higher for longer environment right now. Do those trades then still make sense if we don't get a rate cut before the end of the year?
Mm-hmm. So I do think it still makes sense. So right now what we're doing is we're looking at building fixed income portfolios that are relatively high quality but still can significantly out-yield the U.S. aggregate bond index. Mm-hmm. So if you look at the U.S. aggregate bond index, the yield is around 5%. It's probably a little bit higher after today's move. We can look across the universe, not just treasuries, not just the very high quality stuff, but corporates, high yield, and build a portfolio with a yield around 6 to 7%. And even if yields just stay around here, the return in your fixed income portfolio should generally match the yield on the portfolio, assuming we're kind of in a stable range. So we do think it makes sense. The pushback we hear a lot is that credit spreads are really tight. So that incremental compensation that you're getting for buying corporates versus treasuries is small. We would say yes, it is, but it's justified for the fundamentals. And if you look at other time periods where the economy was equally as robust, you saw similar periods where spreads stayed tight for a long time. And then those periods, it's best to stay invested in the market and collect that carry, clip that coupon, and get that income.
Well, you mentioned kind of investment grade corporate bonds. For investors who are seeing a sell-off in equities like we're seeing today, is that a better way to own some of the names, like a big tech name, for example, to avoid some of the day-to-day dips that we might see in equities that are natural after some of the whipsaws and volatility that we're seeing in the data?
Yeah, so absolutely. I think you want to focus on diversification in your portfolio, things that are going to keep you invested. And when you see a move like we did today, where the 2-year is up 20 basis points, that's probably a 1.5 to 2 standard deviation move. The key is not to get paralyzed, is to think about what are the next opportunities. And what we've noticed is that there is still a lot of money in cash right now, over $6 trillion in cash sitting in money market funds. And typically what happens is once the Fed starts cutting rates, you see that cash pour out because they're no longer receiving those same very attractive yields and chase returns in other asset classes. So right now, this is an opportunity to get ahead of ultimately what we think is going to be the next move being a cut and diversification out of cash into other assets.
Kelsey, when you take a look at the CPI print today, we're going to get PPI tomorrow. What are you expecting to see from that, given what we saw just last month, not too long ago, in the PCE print?
Yeah, no, so that's a really great point, because the Fed's target for inflation, the way that they assess inflation progress, is using the PCE, not the CPI. So the data we got today was CPI. Tomorrow we get something called PPI, the Producer Price Index. And with the combination of the CPI and the PPI, we can project what we think PCE is going to be, which again is what the Fed is ultimately looking at. Now, there's a lot of wrinkles to this story, but essentially PCE, which is the Fed's preferred metric, is running 100 basis points or 1% slower than the pace of inflation in CPI. So we have part of the story right now, but we don't have all of the story right now. And some of the categories that have been particularly hot in the CPI, the one I would point to is auto insurance, which is running around 20% annualized rate. That does not translate into the PCE. The way they measure auto insurance, this is a little wonky, but it's different. And that's one of the reasons why you're seeing this wedge between CPI and PCE grow.
Makes a lot of sense, and great job explaining it, because I think a lot of people don't understand the nuances and the differences and why there is that 100 basis point gap, like you were just talking about, between the CPI print and the PCE print, and then what exactly that means for the Fed's possible next move. All right, Kelsey, great to have you on set. Thanks so much for coming in today.
Thank you.